All right, our next lesson is on something called the Federal Reserve. And we mentioned the Federal Reserve just briefly in our last lesson when we began talking about the money market. Let's review that briefly. So, again, the money market was our last lesson, and we learned that the money market, first of all, the quantity of money is going to be labeled as M1, and the interest rates themselves are going to be named nominal interest rates, and they're going to be denoted with a small r. That's going to be the price of holding M1. We noted that the demand curve sloped downward because as interest rates dropped, people were more likely to take money out of interest bearing accounts and put them into their pockets, into non interest bearing accounts, which is generally M1, or money that we can get to instantly. And the money supply was perfectly inelastic or perfectly vertical. Why? Because this organization called the Fed controlled the amount of money in the economy. With that said, it's probably good to spend a little bit of time on exactly what the Fed is and how it does its job. And we're going to spend a little bit of time on that in this lesson. I want to start with a little bit of history of this thing called the Federal Reserve. And here's actually a picture of the Fed. And you could say they don't build them like that anymore. That is a pretty impressive structure that sits right in the middle of Washington, D.C., and maybe in some ways shows just how important the Fed is by the size and grandeur of its home. Either way, let's talk a little bit about where the Fed comes from. This is not important for you to note for the AP exam, but I thought it was just important to understand a little bit about where it comes from. The reason the Fed was created was because in the years following the Civil War, roughly between 1873 and 1907, bank runs were commonplace. Now, a bank run is when people go to the bank in mass and remove their holdings from a bank. Why would they do that? Well, if they had some reason to fear that banks would lose their money, they might do that. And that happened a number of times between 1873 and 1907. So it became clear that people need to become more confident in the banking system, that it needed to be more stable. Because when banks don't have money in them, they can't lend. And if they can't lend, most of the things that we do in an economy, frankly, don't work very well. So for that reason, banks needed to get more confidence and be shored up. So with that in mind, in 1913, Congress passed something known as the Federal Reserve Act. It was signed by President Wilson, and you can see the newspaper article there trumpeting its signing. One thing that we should know about it, by the way, is that it is known as the Federal Reserve Bank. It's also known as the central bank of the United States. In some questions on the AP exam, they will not refer to it as the Federal Reserve. They'll refer to it instead as the central bank. They are the same thing, just as long as you know both. So the Fed was created with the job of essentially trying to stabilize the banking system. And just another piece of history, in 2014, the lady pictured to your right, Janet Yellen, became the first chairwoman of the Federal Reserve. And so just another sort of piece of history that a woman for the first time chaired the Federal Reserve. Okay, let's take a look a little bit here at what the job of the Fed is. And this is actually very important. There are four main responsibilities that the Fed has. We're going to discuss each of them briefly. The first one is to regulate the banking system. And by that, there obviously are many rules and regulations that banks have to follow. The Fed's job, one of its jobs, is to make sure that the banks are actually doing that, they are actually following the rules they're supposed to be following. So that's job number one of the Fed, to regulate the banking system. We won't spend a lot of time on that in this class, but it's good to know that. A second job of the Fed is to do what we call acting as a lender of last resort. And really what that means is that essentially when the Fed, when a bank in particular needs a loan and no one else will loan to that bank, the bank has the option of going to the Fed directly for a loan. So again, it's not the first choice generally, but when a bank desperately needs money and cannot get it anywhere else, under certain circumstances, the Fed can become a lender to help that bank out. And we'll talk a little bit as we go along here about why the Fed might want to do that and why a bank might ask the Fed to help them do that. But that's the second one. A third one, which is very low on the list at this point in our history, is processing checks. In the old days, literally every check in the United States would have passed through the Federal Reserve and then been sent from the person who signed the check It would go through the account of the person who the check was intended for, and then actually often find its way back to the original signer. All that process is done electronically now. The Fed still monitors that, but it's not a terribly important process. Well, it is an important process. It's not terribly important for this course, so not too concerned about that one. The last one is the one that's going to be the focus of this course, and that is enacting what's called monetary policy. Monetary policy is excuse me, is the way the Fed controls the supply of money. Remember, controls the amount of M1, and in doing so, if we remember our money market graph, also controls the amount of short-term nominal interest rates. And the reason they do that is to keep both unemployment and inflation in check. Now, we'll talk about exactly what the mechanics of that are as we go through the lesson. But in general, the Fed's main job for this course is to enact monetary policy, to make sure that the supply of money sets an interest rate that the Fed believes is appropriate to help eliminate unemployment and to help keep inflation in check. That's a pretty big responsibility. How exactly do they go about doing that? Before we get into the details, I want to share a couple other interesting points of information. And again, this is not something I would expect the AP exam to ask you, but just to kind of give you an idea of how this works. How is the Fed actually set up? The Fed, just to kind of get started here, is headed by a 7-member board of governors, from which the chair is selected. Each member serves 14 years and is appointed by the president and confirmed by the Senate. There's also, this gets a little tricky, there's also 12 other banks that are supervised by this board of governors. And each of the 12 banks has its own district in the country. And you can see a little map there of each of the Federal Reserve districts in the country. There's also something called the Federal Open Market Committee, which we'll get to as we go along. And it's made up of 7 of the governors, 4 of the 12 branch presidents, and they rotate, as well as the New York branch president, which always is on this committee, because generally speaking, so much of the financial work of our country is done in New York that the New York branch president generally is always on this committee. So we'll talk about why the Federal Open Market Committee is so important, but there is the Fed in general, and then there's this committee below it that sort of, it's a subset of the Fed, but is extremely powerful. And I think as we get into this more, you'll have a better, clear understanding of how all this works. By the way, you'll notice that, if I go back for just a minute, each of the members of the board are appointed for 14 years. That's a very long time by standards of most government positions. Only thing that's sort of like that would be Supreme Court justices who are appointed for life. The reason we do that is because we want the Fed to be as independent as possible. The more the Fed has freedom to make decisions, sometimes which will not be popular, the more it can really do its job. The Fed was intentionally set up to be independent of Congress and the President. The President and the Congress generally cannot direct the work of the Fed. The Fed does give reports to Congress and to the President, but it does not have to essentially listen to the President or to Congress. It has to be independent. And the reason, again, is because sometimes the Fed will do unpopular things that are actually in the best interest of the economy. Things that Congress might not do, because Congress always has to worry about elections. The Fed does not. It's there for 14 years, each member. So that's a pretty long term. By the way, just to show you why this is important, one of the Fed's main jobs is to keep inflation low. If you notice, the United States, you'll notice here on the x-axis that it represents how independent each country's central bank is. And on the y-axis, it represents how much inflation occurs. Well, you'll notice there's a definite negative slope between the two things. In other words, the more independent a bank is, the more likely that inflation is going to be kept fairly low. The United States, obviously, you can see is pretty independent, and inflation has been kept fairly low. That's important to understanding how the Fed works. Independence is really, really very key. One of my favorite quotes, by the way, was a former Fed chair who once said, "It is the Fed's job to," as he put it, "take away the punch bowl just as the party gets going." And that is sometimes the Fed's job. We'll talk about when the Fed gets to be the party pooper. But the truth is, Congress isn't always the best at that, because Congress is always worried about elections. The Fed does not have to be. And so the Fed gets to act sort of as the responsible party many times. Okay, let's get into the nuts and bolts now. This is important. The Fed has three tools that it can use in order to make the economy work. The first tool, tool number one, is what's known as the reserve requirement. And what is that? It is the percentage of a bank's liabilities that must be kept on hand or not lent out. Again, it's the percentage of a bank's liabilities that it must keep on hand. It may not lend out. So, for example, if a bank has $100 deposited in its account, and the reserve requirement is 10%, which, by the way, is actually a pretty common historical one, as you can see there to the right. If the reserve requirement is 10%, that means the bank can only lend out $90. It may not lend out all $100. Why did the Fed create that rule, by the way? The reason that is because that helps stop people's fears about the bank not having their money. One of the things that's caused bank runs in the past is that people would show up at a bank and the bank would literally be out of money that day and couldn't give them money. To help avoid that, the Fed says you must keep a certain amount in your bank at all times. Now, that's the reserve requirement. If that's the case, then what do we have here? If you lower the reserve requirement, banks will lend more money. If that's what the Fed does, if the Fed lowers the reserve requirement, banks are going to be able to lend more money because they don't have to keep as much. So if the Fed went from 10 to 5% reserve requirement, now out of that $100, banks could lend more money to people, put more cash in their pockets, and therefore increase the money supply. Of course, the opposite is also true. If the Fed decided that it was going to be raising the reserve requirement, then banks could lend less money. So instead of, if they raised it from 10 to 15%, then the banks could only lend out 85% to put cash in people's pockets. So because that's all true, the Fed uses the reserve requirement from time to time to help control how much money there is. So again, if it lowers the reserve requirement, banks will lend more money and the money supply will increase. If it raises the reserve requirement, banks will lend less money and therefore the money supply will decrease. That's tool number one. Tool number two of the Fed is what's called the discount rate. We'll start by defining that. The discount rate is the interest rate at which banks borrow from the Fed. And by the way, for what it's worth right now, it's less than 1%. Why would a bank borrow from the Fed? Well, one of the reasons banks borrow from Fed is to meet that thing we just learned about, the reserve requirement. If at the end of the day the bank was supposed to have $10 in the bank out of 100, but it only had $8 and it needed 2 more, where could the bank go? Well, there are a lot of places, things the bank could do. It could sell something that it owns to put the money back. It could go to another bank, which is very common, and get a loan. But the last way, remember the last resort that a bank could do, is go to the Fed and borrow that money. And it would borrow it for a very short period of time. Generally, they're called actually overnight loans. Not very long. So the Fed can do that. And when it does that, it charges an interest rate to the bank. So let's think about this. If the Fed increases the discount rate, in other words, it makes it more expensive for a bank to borrow money, then in that case, the bank's going to be more likely to be careful not to have to borrow from the Fed. So they may not lend out as much money. So if they increase the discount rate, that means borrowing becomes more expensive for the bank, so they lend less, which decreases the money supply. So to summarize that, if the discount rate is increased, the money supply is going to decrease. And of course the opposite, if the Fed decides to decrease the discount rate, then what happens? Then it's easier for the banks to borrow. The banks are likely to lend out even more because they know if they have to borrow, it's not very expensive, and the money supply at that point would increase. So tool number two, the discount rate is, again, what it is, it's the rate at which the Fed loans money to banks. If they increase it, that means the money supply is going to decrease. If they decrease the discount rate, that means the money supply is going to increase. Now the truth is the first two tools, the reserve requirement and the discount rate, are the two less commonly used ones, though the AP exam generally will accept any of these answers. The most common one, the one that is used literally every day by the Fed is our third tool, and that is what is known as open market operations. And that is the following: it's controlling the money supply by buying and selling federal government bonds, or often known as securities. Okay, let's get into the details here. This is the primary tool that the Fed uses to set what's known as the federal funds interest rate, or the interest rate at which, now be careful, at which banks borrow from each other. So let's make sure we're clear about the difference. We just recently, in our tool number 2, learned about the discount rate. The discount rate is the interest rate at which banks borrow from the Fed directly. This thing called the federal funds rate is the rate at which banks borrow from other banks. Now, let's see if this makes any sense. How does the Fed use the buying and selling of bonds in order to increase or decrease the money? Well, let's suppose the Fed decides that it is going to purchase lots and lots of bonds. Remember, the Federal Reserve is the one that is responsible for creating money. So, if the Fed decides to buy a bunch of bonds off the market, then what's going to happen? In that case, what's going to happen is the bond is going to be given to the Fed. And in exchange, the Fed is going to give that person cash. So when the Fed is buying bonds, now remember what bonds are. Bonds are simply IOUs. It's a loan that you've given to the government, and they've given you a piece of paper saying, we owe you this money back plus some interest. Okay? Those bonds have some value. The Fed will buy those bonds, and in exchange give the person cash. And with that cash, the person can then go spend and do whatever they're going to do and increase M1. So to summarize that point, when the Fed wants to increase the money supply, it buys bonds. When the Fed wants to decrease the money supply, it can sell bonds. And that's essentially the opposite function. When it sells the bonds that it has, it takes cash from somebody who wants to buy the bond. In exchange, the Fed gives them the bond. The Fed then takes that money and essentially puts it in its own vaults and keeps it out of the money supply. The details are not so important, but it's kind of nice to understand what's happening. The key is this: when the Fed decides it's going to buy bonds, it's putting more money into the economy. When the Fed sells the bonds that it has, it is essentially taking money out of the money supply, out of the economy. Just as a point of reference, this is the tool the Fed uses literally every single day. The discount rate and the reserve requirement, the Fed does not change very often. That's sort of like dropping a bomb on the economy when it does those first two things. But this buying and selling of bonds, the Fed literally is doing every single day. And by doing that, what it allows the Fed to do is set an interest rate, an exact interest rate that it wants. So let's look at what that means exactly. If we go to the money market, we take a look at it. Here's our money market. This is an exact drawing of what I would like you to have. If the Fed needs to increase the money supply for some reason, what's it going to do? Well, the first thing it notices that the interest rate is at, let's say, R1. It decides it wants the interest rate to be lower. And our next lesson is why the Fed might want this to happen. But the Fed decides it's going to lower the interest rates. Well, it does that by increasing the money supply. And by doing that, interest rates are lowered. And what were the three options it had? It could lower the discount rate, it could lower the reserve requirement, though those are less common, or it can do what it does essentially every day, which is buy bonds in this case, to lower the interest rates by increasing the money supply. Of course, the opposite is also true. If the Fed decides that it needs to raise interest rates, there's our initial interest rate, then it can actually decrease the supply of money and therefore raise interest rates. This is all review. Really what the Fed does essentially is it picks a certain interest rate. Whatever that interest rate is, remember that changes in money demand can also affect interest rates. So what happens is the Fed essentially decides, I'm going to pick an interest rate. Maybe it's R1. No matter what happens to money demand, the Fed's going to jump right in and adjust the money supply literally on an hour by hour basis to make sure that the ending interest rate stays exactly where it is. It's true the Fed controls the money supply, but really what the Fed is controlling with the money supply is the interest rate. The Fed gets to pick the interest rate that it wants, and that's the key to understanding monetary policy. The Fed controls those nominal interest rates. Okay, let's try an example together. The Fed decides to lower the discount rate. Draw a quick graph and show us what that would look like. You can stop the recording for a moment to do that. Okay, the Fed has lowered the discount rate. The discount rate was the rate at which banks borrow from the Fed. So if it's cheaper for the banks to borrow from the Fed, they will probably be lending out more money, and therefore the money supply will increase. And that's what I have here in my graph. Because the money supply increased, interest rates dropped from R1 to R2. Let's try another example. The Fed raises the reserve requirement. Again, we'll stop it here for a moment and give you a chance to try it. Okay? The Fed raises the reserve requirement. Now, in doing that, the money supply is decreased because banks have to hold on to more money in their bank that they cannot let go out in the form of loans. And because that's true, interest rates are going to rise. That concludes our lesson on the Federal Reserve. In our next lesson, we'll be talking about how the Federal, or why the Federal Reserve might want to raise and lower interest rates.